start off with the set of circumstances confounding the Fed and the US economy at the moment. You take a look at rates pricing, crude pricing. Clearly, markets are expecting worse economic conditions than the Fed is. Does the banking turmoil potentially worsen that outlook?
Well, yes. I mean, even before we saw the regional banks coming under stress, a month or two ago, we were arguing that we're likely to see a recession in the coming 12 months. And really, this comes down to a lot of the indicators that we look at, whether it's consumer confidence, business confidence, and obviously the shape of the yield curve as well, which are all pointing towards a heightened risk of a recession going forward. And as you mentioned, now that we've got the regional banks under significant stress, and we just seem to be going from one organization to another, and until the authorities do something to sort of stop that sort of domino effect, I think we're going to continue to see that. And that is obviously a concern from a credit lending perspective within the economy, and it just exacerbates the challenges already faced. So, we're not quite as aggressive on Fed rate hikes later this year. So we're only looking for 2 25 basis point cuts by the end of this year, probably towards the tail end. Markets obviously looking for around 4, but from our perspective, the Fed is already tightened too much, and that is going to lead to a pretty poor economic outcome later this year.
And it looks like that US exceptionalism when it comes to US equities may have come to a halt as well. What are you liking in terms of Asia and potentially even emerging markets? It's preferential to developed markets at this point.
Yeah, so obviously the developed markets, particularly the US, look to be the epicenter of all the challenges being faced by the global economy. Obviously, the reopening of the Chinese economy is a very big positive from a growth perspective, from a global growth perspective, as well as obviously the domestic economy. We also think that while a lot of people focused on the dollar smile, saying risk off is good for the dollar, we say when the epicenter is the US, that's not necessarily the case. So we expect the dollar to weaken. So if you look at the growth differentials between developed world and Asia, and also that dollar outlook, it paints a picture for Asian equity outperformance going forward. Actually, not just equity, but also in the bond space as well. So that's where we're sort of taking a bit more risk than in overall portfolio, we're underweight equities, but we have a tilt towards Asia within that.
Given what you're saying about the environment right now, especially that you expect Fed rate cuts later this year, how bearish are investors positioned, and is there a risk for a melt-up trade at some point?
Yeah, so I think that's what we've been seeing, to be honest. I think this would be the most predicted recession, certainly in my career. Economists are typically, and I'm an economist by training, they're typically bad at predicting recessions, right? So this has been very foretold, if you like, if we do see that recession. A lot of people have already been focused on it. And that's been reflected in positioning in risk assets. So we've seen since October last year, equities do pretty well. And obviously that's continued this year. And that's basically been, the consensus has been we're going to see a recession. That's bad for risk assets. We've seen that in positioning data in particular of late. So, we do think that, I think in the short term, you've got this risk of sell in May. So, is this the sort of peak, and is the last 2 days of trading the signs that sell in May seasonality is going to come back? Or is it going to be positioning that will win out? I think, from our side, in the next few weeks, positioning may well win out, but we'd be fading that melt up in equity assets, given our fundamental views on the economy.